All right, and we are live. Can you guys let me know if you guys can hear me? I got a little bit different setup this week. We had some technical problems last week, and hopefully this setup helps you guys see my face while presenting, as well as gives you guys the audio without any big adjustments. So let me know if you guys can hear me, if everything's sounding good, and we'll go ahead and get started. There's a little bit of a lag, so I'm just waiting to see if we get any responses that you guys can hear me. Just let me know in the chat if you can't. If you can't, also let me know that as well, because awesome. Okay, thanks, Richard, Paul, how you guys doing? Welcome, joining us. Okay, let's go ahead and get started. So today we're going to be talking all about the Social Security tax torpedo. So Social Security is a little bit ironic in the way that Social Security for a lot of you will be one of your most tax preference assets that will help you save considerably on taxes. But if you're not careful, it can also put you in a tax trap that essentially causes you to be double taxed. And so we're going to talk about that tax trap and why it's so important to avoid. As always, everyone on this webinar, if you like the ideas and you want to see how they apply to your situation and see how you can avoid the tax trap, we have a retirement strategy session that everyone's entitled to that watches this webinar. That strategy session will be with both Tony and I. And so this is basically what we're going to be talking about today. Whether you guys realize it or not, when you retire and you turn on Social Security, you enter a completely different system. Okay? Working while you're earning money, earning income from a job, taxes are pretty simple. Okay, the job that the money you earn from that job is taxed in our gradually increasing marginal tax rates. And for the most part, things are simple. But once you enter retirement, you turn on Social Security, you enter this new tax bracket. And as you can see on this screen right here, and we'll explain it as we go through this Wealth Wednesday, you'll see that your marginal tax rate jumps up. And it can jump as high as 85% higher. And so you might be in the 22% tax bracket, but because of how Social Security is taxed and because of this tax trap, you're going to be taxed at 40.7%. Now, obviously, that's important to know because it means you're only getting 60 cents on the dollar for every additional dollar that you take out. So we're going to explain depth. But first off, I want to explain how important Social Security is to get right in order to save on taxes. So we sent this out to our email list last week. If you're not on that email list and you want to get a weekly video from Tony or I sent into your inbox, just go ahead and comment in the chat, and either Tony or I will add you. We'll private message you and add you to that email list. But we showed this exact example. So there's a retiree that needs $84,000 of income in retirement. Now imagine they didn't have any Social Security. Okay, so they were taking that entire $84,000 from their IRA, and so the entire amount was going to be taxable. Well, in current tax brackets, they would owe $6,650. So what happens if they have a Social Security benefit? How can Social Security save on taxes? Well, if they take at 62, in this example, we have this is a married couple, and we have them filing at 62 and getting $32,000 a year from Social Security. Okay. Now, because they filed at 62, their Social Security benefit is permanently reduced. Okay, they get a penalty for filing early. Now, to reach that $84,000 of income need, they're going to need to withdraw $52,000 from their IRAs. Now, notice that having a Social Security benefit does save them a little bit on taxes. Their taxes go from $6,650 to $6,000. So they save about 10% on taxes. So there are tax savings that Social Security can provide. However, because they filed at 62, they're not only getting a permanent reduction in benefits, they're also throwing their tax situation kind of for a loop as well. So what happens if they delay Social Security? Okay, they maximize it, and If they do that, instead of $32,000 coming from Social Security, it gets bumped up to $56,000 because they get delayed credits. Social Security grows by 8% a year if you delay after full retirement age. Now, again, to reach that $84,000 income need, they need to take $28,000 from IRAs. But notice the tax situation. Taxes drop by about 70% to $1,950. Now, why is this? It's because of how Social Security is taxed. So let's jump into that. Before doing so, though, it's important that I want to get some key tax terms out on the table so that everybody understands them as I'm using them throughout this presentation. So it's this idea between marginal tax rate versus effective tax rate. And so let's say you're a single filer and you're earning $84,000 a year. That would put you in the 22% tax rate. Okay, now that is your marginal tax rate. So marginal tax rate is basically the last dollar that you took as income, what was that taxed at? And so in this example, the first $9,700 is taxed at 10%. Then from $9,000 to $39,000, it's taxed at 12%. And then from $39,000 to $84,000, it's taxed at 22%. So the last dollar that this person took as income is taxed at 22%. So the marginal tax rate is 22% as well. Now, overall, they're going to owe a little over $14,000 in taxes. So their marginal rate is 22%. Their effective rate you get by dividing the taxes owed by the amount of income they received. And so they're going to owe $14,000 in taxes. That divided by $84,000 is 17%. And so their effective tax rate is 17%, but their marginal tax rate is 22%. So why is this important? Well, this is important because we want to know whenever we're making a decision where to take from in retirement, we need to know our marginal tax rate. For instance, let's say we're in the 22% tax rate if we take from our IRAs. Well, we might only be in the 15% tax rate if we take from taxable accounts and we incur long-term capital gains tax. And so we need to know what our marginal tax rate is so we know how much more income to take from potentially a taxable account, potentially a Roth IRA account, and such. And so we're going to be talking a lot about marginal tax rate as we go through this presentation, but let's cover how Social Security is taxed. Okay, so it's taxed based on this complex formula called provisional income. And income is determined by you take your adjusted gross income, and so that would be things that would be included in that are earned income from a part-time job, IRA withdrawals, any capital gains that you incur throughout the year. Things that wouldn't be included would be like withdrawals from Roth IRA assets. And so when you withdraw from a Roth, it's completely excluded from this provisional income equation. Then you take that plus tax exempt income, so that would be like muni bond interest, and then plus 50% of your Social Security benefit. And so in this example, I'm going to walk you through and go to the whiteboard in a sec and show you, okay, we have $30,000 in IRA withdrawals, and we have $40,000 in a Social Security benefit. What are we looking at for our provisional income? Okay? And so we take this, and we have $30,000 in IRA assets. So that's our adjusted gross income. We don't have any tax-exempt income, so that'll be zero. And then we plus that we add in half of the Social Security benefit. So I believe in this example I had it at, 40,000. And so that would be 20,000. And that gives us a PI of 50,000. Okay, does that make sense to everybody? Okay, so you plug in how much income, your adjusted gross income, and then you plus any tax-exempt income and add in any half of that Social Security benefit. So that gives us a $50,000 provisional income. Okay, we'll call that PI. Okay, so let's go back here. How does this translate, though, into how much your benefit actually gets taxed? And so in this example, I think I have this as married. I'm actually going to show this is a single filer. I'm actually going to show this as a married filer. But if we look at this table here, based on your provisional income falls, it determines how much of your benefit gets taxed. So for a married filer, this middle row here, we notice that, okay, if it's less than 32, Social Security is tax-free, okay? Between 32 and 44,000, up to 50% of your Social Security benefit is taxed, and then more than 44,000, up to 85% is taxed. Now, it's important to understand, and a misconception that I often see is that people think once they cross over 44,000, it instantly 85% of their benefit is taxed. And that's actually not the case. Okay, so let's jump into the whiteboard again and show you exactly how this pans out. So we have, up here we have $0 all the way down to our $50,000 provisional income. So between $32,000 and $44,000, that's a $12,000 range. Now 50% of our benefit is going to be taxed in that range. So it's a $12,000 range, and it's going to be taxed at 50%. And so in this range, $6,000 of our Social Security benefit moves into becoming taxable. Okay, but then we have more than $44,000 of taxable income, or of a provisional income, sorry. And so from $44,000 to $50,000, we know that's a $6,000 range. And we're going to owe 85% of this range, and that's going to move into that's going to move our Social Security into being taxable. So that's $5,100. And so even though, keep wanting to add a zero, even though we're over that 44,000 provisional income number, only $11,100 of our Social Security benefit is going to move into becoming taxable. Okay, does that make sense? Does that clear this up a little bit? So it's not that you cross over 44,000 and 85% becomes taxable. It steps up as you earn more income. And so the most your benefit can be taxable is up to 85%. And so eventually, as we add on more income, this number that we're going to owe is going to go up. And so right here is where the Social Security tax trap is created. Okay, and let me see what I got for the next slide here. Okay, so the reason it's created is, let's use an example. Okay, so we're taking the same example we just used, a provisional income of $50,000. Say this using a marginal tax rate of 22%. That's probably high. I didn't calculate it out exactly, but let's say for this example, you're at 22% marginal tax rate. Okay, well, let's go through a thought experiment. Let's say that, so this person has $70,000 of total income, because remember, they're taking $30,000 from their IRAs, $40,000 from Social Security. Let's say their breaks down, and they need an extra $1,000 from their IRAs in order to fix it. Well, what is the tax rate? What is the marginal tax rate of that extra $1,000 withdrawal? Well, if we add $1,000 from our IRA withdrawals, it increases our PI to $51,000. What that does is we're going to owe tax on the extra $1,000 from the IRA. Okay, we're in the 22% marginal tax bracket, so that's going to be $220. But notice, because our provisional income goes up by $1,000, it's going to cause this to go up by $1,000 as well. So we're going to owe $7,000 at 85%. So that $1,000 is going to move $850 from our Social Security benefit into being taxable as well. And so the tax that would be owed on that, let me just quick throw this in here, it's going to be $187. And so on that extra $1,000 withdrawal, we're going to owe $407, or otherwise 40.7%. Okay, do you see how the tax rate jumps up? Because it forces more of your Social Security benefit into being taxed, that $1,000 withdrawal, not only do you owe taxes on that extra withdrawal, but you also owe it on the extra Social Security benefit that moves into becoming taxable as well. And so we can map this tax bracket out. And on the bottom here, I think I should have I'll be able to draw here as well. On the bottom here, we have our AGI, okay? And so in this example, we have $62,000 of Social Security benefit, and we can see at each AGI, at each IRA withdrawal period, how much we're going to owe and what tax bracket we're going to be in. And so, for instance, if we took $12,000 from our IRAs and we have a $62,000 Social Security benefit, we don't have any tax, okay? We're in a 0% tax bracket. You don't owe anything to the IRS. But notice, as we add more IRA withdrawals, we jump into this tax trap zone. And so from, looks like $17,000 here, all the way to, looks like $69,000, our tax trap, our marginal tax rate is going to jump up because it's forcing more of our Social Security into being taxed. And so we're going to owe taxes not only on our IRA withdrawals, but also on our Social Security benefit. And so for a zone here, we're going to see our tax rate up by 50% here. And then from this zone to this zone, we're going to see it go up by 85%. And so this is extremely important to understand as you're taking Social Security and deciding where to take assets from. Okay? If you're up here, you are taxed at 40.7%. And so if we know that, we might want to take from our Roth assets in this zone here, okay, to make sure that we're keeping that income rather than losing 40% of it to taxes. And so this tax trap, again, extremely important to understand, but there's a few ways you can avoid this tax trap, okay? A few would be to maximize Social Security. The more income that you have coming from Social Security, the further away this tax trap starts. And so if you file at 62, not only are you getting that permanent reduction in benefits, but you're going to find yourself in the tax trap throughout retirement in most cases. Because rather than taking from Social Security, you're going to be forced to take from your IRA assets. And it's going to continually push you into this tax trap, causing you to be double taxed. Another way to avoid the tax trap is while you're delaying Social Security, do some Roth conversions, okay? We want that Roth conversion we want that Roth asset group to be as large as possible, because then we have control over our assets, okay? If we find ourselves in that 40.7% taxable zone, we'd rather take from Roth assets. Well, if we don't have any Roth assets, we're just forced to take income and lose a bunch of it to the IRS. And then again, strategic withdrawals, okay? Rather than taking from IRAs, maybe we take from our taxable account. And so our capital gains rate will be lower. It'll still force our Social Security into being taxed, but rather than being the 40.7, we might be closer to high 20s, okay? Or we can take Roth assets, or we can take from a checking or savings account and completely avoid taxes altogether. Now, here's the thing. When this is kind of a complex webinar that we're doing today. Hopefully the whiteboard helped you understand it a little bit. But oftentimes after it's in front of a group of 50 people at our max Social Security event, I get the question, okay, will this tax torpedo affect me? And the thing is, it will affect anyone who has a Social Security benefit. So the thing is, though, everybody's Social Security or everybody's tax system, their retirement tax system, and when they'll cross over into being in the tax trap will be different based on your Social Security benefit. So yes, it will affect every retiree with a Social Security benefit, but it will also affect everyone differently. And so I can't say that, okay, once you make more than $15,000, or once everybody makes more than $15,000 from their IRA assets, then you'll be in the tax trap, because it's going to be different for everyone. And it becomes more of a problem over time. This is a key point to understand. The reason being is because of this thing we've talked about ad nauseum if you've kind of been in our content circle. In 2026, the Tax Cuts and Jobs Act is expiring. And this does a couple of things. One, it raises the tax rate by about 3 to 4%. And so prior to, let me just pull up my marker again. Prior to the Tax Cuts and Jobs Act, this was the law. This was the tax rates. And then for the last, from 2018 to 2025, this is scheduled to be the new tax rates. And so across the board, we see that tax rates drop by about 3 to 4%. Well, in 2026, this is going back up. The other thing that the Tax Cuts and Jobs Act did was it raised the standard deduction across the board. And so for a married filer, current standard deduction is $24,800. In 2026, that's going to be cut in about half. And in 2018, it was 13, or in 2017, it was 13,000. So what is this going to do? Well, if you have a benefit coming from Social Security, let's say right now you have $62,000 coming from Social Security and you're taking $40,000 for IRA. This year you will owe $4,900 in taxes. Well, if we took the same scenario in 2026, after the Tax Cuts and Jobs Act expires, your taxes almost double to $7,500. And so taxes are going up in the future. And so the tax trap is going to get that much more, costly, I guess, for retirees. Because if you're in the 22% tax bracket right now in that tax trap, that's going to the 25%. And so your taxes go up by 85% on 25. And so rather than it being 40 points, it's going to be like 45% that tax trap zone is going to force you into. Okay? The reason number two is something that we refer to as stealth taxes. And so the government, in order to deal with this massive debt problem, has basically tried to slide laws, stealth taxes, underneath the table and hope that no one notices. Well, we notice, okay? And an interesting thing about these provisional income thresholds is they haven't changed since 1983. So in 1983, when they were installed, Social Security was only supposed to be taxed on a small, wealthy portion of the country. And so $32,000 to $44,000 in 1983, inflation adjusted to now might be $100,000. Okay, well, these haven't been adjusted since 1983, and I don't think there are any plans to change that adjustment. Okay, so if these stay at their 1983 levels, and we fast forward another 30 years, okay, your income is going to have to go up due to inflation. However, if these thresholds don't change, it's going to continue to force more of your benefit into being taxed. And so basically what it does, I created a cool program that basically maps out your retirement tax brackets in every year for the rest of your life, as long as you want to go out. And so we inflation adjust your income, we inflation adjust your Social Security benefit, and we keep the thresholds where they are, and we adjust the tax brackets. And so basically, I don't expect you to fully understand these two graphs. The only thing I want you to take away from is noticing, okay, this year we have a decent gap before Social Security starts being taxed. And so that basically what that does is it delays this tax trap here. Well, as we move through time and your income adjusts for inflation, but those provisional income thresholds don't, what it's going to do is it's going to shrink this no tax zone, if you will. And it's going to cause you to move into the Social Security tax trap much sooner. It's going to cause the Social Security tax trap to widen as well. And so it's super interesting to see as you move through time, not only where your income's going to be, if we see inflation, where your Social Security benefit's going to be after inflation, and then how much taxes you're going to owe. So some key information on this front is, okay, for one thing, if we just zoom out, if you forget about the tax trap and you don't plan around the tax trap, it can cause the average retiree right now up to $6,000 in extra taxes. But because provisional income, those thresholds aren't adjusting to inflation, it's going to cause more money to be taxed each and every year. And so I ran a quick study, and at 2.25% inflation, your tax inflation rate, so what I mean by tax inflation rate is how much do your taxes grow, the taxes that you owe grow from year to year. And on average, because of these stealth taxes, your tax inflation rate is going to grow by 4 to 5% per year. And so that's right in line with basically what healthcare is growing at. And so when we think about inflation and how much taxes you're going to owe down the road, this tax problem is only going to get bigger. That's why we say taxes are your single biggest expense in retirement. If taxes rise, so do withdrawals from your portfolio. So if you owe an extra $1,000 this year in taxes, you're going to have to withdraw that from your portfolio. And so it hurts your long-run success for your retirement. It forces you to run out of money sooner rather than later. And so in your example, does your AGI include all tax-deferred income as well as any tax? So yes. So this is why, this is a great question. So in your example, does AGI include all tax-deferred income as well as any taxable income such as a pension? I have a pension. Would that put me in the tax trap? So yes, this is one of the reasons that we think having an annuity, for instance, with an income rider, so an annuity that forces you to take income out each and every year, it sounds great because your income is going to be stable throughout retirement. However, it also forces you into the tax trap without any options. And so that pension or that annuity is going to force you to take out whatever income each and every year. And so this has to factor into deciding whether to lump sum a pension or whether to keep the pension. We have to be thinking about taxes as well. So that was a great question. Yep, so that would be included in AGI. It would force you into the tax trap, 100%. And so in summary, Social Security maximization is more than just figuring out when to file. Okay, it's not just, should I file at 62, age, or 70, or somewhere in between. You need to be in taxes when deciding when to file. If you file at 62, you better have a really good reason, because if not, you're going to be forced to pay higher taxes throughout your retirement. And your tax inflation rate, so this is why I think as well, Social Security tax planning needs to be one of the most important things your retirement planner does. Okay, in the examples we showed, you have multiple thousands of dollars that you can save each and every year by adjusting your plan to this tax situation. Okay. Also know your tax inflation rate is going to rise faster than the normal inflation rate. In our example, at about twice as fast. This is similar to the healthcare inflation rate. And what it means is tax planning is only going to get more important as we go down the road. This is also a reason that we say it's so important to make sure we have your RMDs in line and make sure that we're planning and estimating your RMDs down the road. Because just like a pension can throw you into the tax trap, so can an RMD. All of a sudden, you're in a 0% tax rate because you did a great job planning your Social Security benefit and your income from ages 62 to 72. And then at 72, an RMD spits out $30,000 that you don't exactly need for income. And so it forces you in that tax trap and you lose a bunch of that $30,000 to taxes. And so we're big on making sure that that money stays in your pocket and out of the IRS's pocket. So if you're interested in learning more about the Social Security tax trap and how it actually applies to your situation, go ahead, schedule a retirement strategy session with us. If Tony's in the chat, Tony, could you go ahead and put a link to a strategy session in the comments and so people can basically book a strategy session with us. And again, we can not only tell you kind of when you should file and when you can maximize your Social Security benefit, but also show you each and every year for the rest of your retirement where that tax trap's going to be so you can avoid it. Okay, so always remember, guys, you don't need more money. As we show in all of these Wealth Wednesdays, there's things you can do to lower expenses, you can do to maximize Social Security, and that means you don't need more money in your retirement savings. You need a better plan. You need to avoid taxes because every dollar saved on taxes is a dollar you can spend in your retirement. Hopefully this was educational. I didn't see any more questions coming through, but go ahead and put them in the comments and the replay of this, and either Tony and I will reach out and help answer that question. Thanks a lot, guys, for watching. Appreciate it, and we'll see you next Wednesday.